2022 might bring a crash in the real estate market and the economy bigger than 2008. In short, according to the epic housing crash theory, traditionally secure investments in commercial real estate have been propped up by volatile equities and securities. Volatile and risky equities like stock derivatives and other things have been unintentionally or somewhat intentionally tied to the illiquid and traditionally secure commercial real estate market. This might sound somewhat familiar, and it's similar to what happened in 2008. Hi guys, welcome back to Glory Investing Show, and in today's video, I'm going to explain why the upcoming recession will be worse than 2008. So let's dive in a little bit deeper into the video, and we'll start with an analogy to understand what's happening. But before we do that, you should understand how the 2008 crash happened. How the Great Recession started. Mortgage-backed securities, or MBSs, are a type of asset-backed security that is created by pooling together only mortgages. When an investor purchases a mortgage-backed asset, he or she is effectively lending money to homebuyers. A broker can help you buy and sell an MBS. The minimum investment differs according to the issuer. Mortgage-backed securities are only as safe as the mortgages that back them up, as the subprime mortgage debacle of 2007 to 2008 demonstrated. The financial disaster. The financial disaster was triggered, according to the 2008 financial crisis report, by an overextension of mortgages to vulnerable borrowers. These allegedly safe residential mortgage-backed securities, or RMBSs, were repackaged and marketed to eager lenders tempted by inaccurate risk ratings. Rating agencies allegedly assigned the coveted AAA rating to unsuitable RMBSs, notably in the subprime sector, making them the bad guy in this story. As the narrative unfolded, the ratings resulted in significant losses for institutional investors who had placed their trust in rating agencies. How CMBS works. To understand just how bad the commercial mortgage-backed securities mess is, you need to understand how CMBS works. At first glance, they're similar to regular MBSs. It's a bundle of tens or hundreds of mortgages for commercial properties. They're divided into tranches, usually 6, and the lowest tranches pay out the highest yields, but also fail first. And now things get a little complex, so I'm going to simplify it, but this is the most important part to understand why this is all going to blow up. A commercial building is an income-producing asset, and its market value is determined by the amount of revenue it generates. The bank that lends you the money will require you to put up some form of collateral. When rents rise, the amount of collateral you must post decreases. If your rent decreases, the amount of collateral you must provide increases. The strange thing about CMBS loans is that if just half of your building is rented, you can pay half of your mortgage, and whatever you owe on the other half of the building is simply added to the end of the loan. Now, say you can't rent out the empty half of your building, and you want to renegotiate the terms of your loan rather than just keep adding debt to the back of your loan. Well, this is where the CMBS comes into play because of all those different tranches, the investors behind them have different incentives. The guys at the lowest tranches don't want you to modify the loan because that means losses, and they take those losses first. While the guys at the highest tranche want you to modify the loan because it generates more income for them, and they're not eating any losses. Unfortunately for you, in most CMBS agreements, you need a supermajority of 70 to 80% of the votes to get a loan modification. So since you can't receive a loan modification, you, the landlord, will have to write a check to the bank to cover the difference between the value of the building at the previous higher rental rate and the value of the building at the new, lower rate to get the building rented out. You can either do nothing and get an extra tax deduction, or you can do something and hope that someone comes along and rents at a higher price or buys the place from you, making it their issue. This is why you'll find so many empty storefronts with crazy asking prices that the landlords won't bend on. They can't afford to. While we're talking about affordable staff, make sure to check incomeaddict.com and use our code GLORY for a 20% discount on the entire store. The current situation. We skimmed just the teeniest top of the surface on this subject, but all of those CMBS notes that are super toxic start coming due in March of 2022, and they're going to detonate the commercial property market. Now, before going any further, we need to take a look at what experts are saying about the upcoming recession. As per a report published by Fortune.com on May 22 of this year, the S&P 500 is down 19% since the start of this year, and the tech-heavy Nasdaq has fared even worse, plummeting over 28%. But we could be just halfway through the stock market decline based on historical trends. Between March 2000 and October 2002, the Nasdaq 100 sank 78% as once loved but largely unprofitable tech firms fell by the wayside. Many banks and investment groups will be destroyed when these go bad, just like in 2008. The first reason why this theory suggests that 2022 will be worse than 2008 is that the risk is not accurate, which are loans for commercial buildings, businesses, malls, things like that. That is then packaged up and sold off as investments for other investors to buy and invest in. But here's where the first problem comes in. When Wall Street buys real estate, they're usually subject to one risk assessment, which is assets under management, or AUM. This is the amount of money that they are managing for their investors. So it's essentially like them coming up to a bank and saying, "Hey, here's the size of my wallet. Can I get a loan now?" And they get their loan and they go and buy real estate. But the truth behind the risks assessed with real estate is that it has less to do with the size of your wallet and more to do with things like rental rates, real estate values, stock values, and local conditions, like crime rates and other things that have nothing to do with the size of the wallet, so that's the first small risk. The second problem with CMBS is the liquidity of assets. Liquidity of assets means how easy or hard it is to sell an asset. Now, one of the reasons Wall Street hedge funds and investment banks can do things like leverage up at 37.5 to 1 or say 200 to 1 is because the money is backed by securities and derivatives and other financial instruments which are extremely liquid. So if things go tits up like the Titanic, the lender can force a sell-off of this stuff very quickly to get their money back. But it is not true to happen because housing is illiquid. It takes a lot of time and effort to sell a house or buy one. There are special rules and whatnot from the federal government about what kind of collateral and stuff you need for a residential house. 2008 was so bad because the banks ignored all of those. After 2008, one of the few things the government sort of did fix was tightening up lending standards for retail, so everyone who's looking at the last crash sees that retail borrowers aren't over-leveraged with bad loans and subprime mortgages and thinks that it can't happen again. But all of those rules and whatnot get ignored if the buyer is paying cash. It's not a good situation at all, but the theory is based on assumptions. So, at the end of the day, this could be completely false and none of this happens at all. But if this idea does fall apart, we don't believe it needs to happen as quickly as it did in 2008. Perhaps the value of the commercial or residential real estate will remain stable or drop during the following decade. Nobody knows. But one thing is certain if you're looking to buy a home, especially right now, and since you're happy with your interest rate and the numbers add up, and you're taking out a 30-year loan, it doesn't matter how much your house is worth because, in the end, a house will always be a house. Final thoughts. Let us know your thoughts in the comments. Is this what we will face in the near future, or can we overcome the housing crash? I hope that you guys enjoyed the video. If you found it helpful, make sure you smash the like button and share it with your friends. Don't forget to share your thoughts with us in the comments section below. And while you're here, click to watch one of the other 2 videos appearing on your screen right now. I'll see you there. Take care and stay tuned.